It's a tale of three currencies and one continent. One currency has been the world's best performing in April. Another is now pegged to gold reserves, while another faces devaluation in exchange for a financial bailout. Here in Nigeria, the Naira is gaining against the US dollar after reaching an all-time low of 1,850 on the parallel market and 1,627 on the official market in March. However, a raft of measures by Nigeria's central bank is helping it regain lost value. Elsewhere on the continent, Zimbabwe's new currency has replaced the old Zim dollar, which fell by more than 70% this year. The new currency began trading on the 8th of April and is backed by gold valued at $285 million. But that's less than 2 weeks import cover and a 12th of the Southern Africa Development Region's recommendation for liquidity. Finally, Ethiopia, which is struggling with high inflation, became the third African state in as many years to default on its debt in December. But the IMF usually favors flexible, market-determined exchange rates and has received a $3.5 billion support request from Ethiopia. Is the Ethiopian B devaluation in the offing? These are three big questions. What specific policies accounting for the Naira's appreciation? Will Zimbabwe's new currency stand the test of time? And how can Ethiopia avoid a currency devaluation? To help me wade through these currency stories, I've got Dr. Muda Yusuf, CEO of the Center for the Promotion of Private Enterprise and former DG of the Lagos Chamber of Commerce and Industry, as well as Steve Osho, Managing Director at Commercio Partners Capital Limited. Thanks for joining me on the show, Dr. Muda. Great to see you, and of course, Steve, for staying back. And Dr. Muda, I'll start with you. The last time you were on the show, actually, I was speaking to you. We were also talking about which way for the Naira. Then it seemed like we were in a free fall. Now the tide has turned, and quite radically. How do you assess the impact of the CBN's policies in helping to stabilize the Naira?
No, it has been very significant and very positive. And the evidence, is out there. So it's something that is commendable. Of course, we had a combination of policy measures. We had the liquidity, angle to it, that is, managing liquidity through the monetary policy instruments, the MPR, the CRR. Then we also had measures that have been taken to sanitize the market.
Right.
Because one of the biggest issues we had in the foreign exchange market was all the abuses, the speculative activities, the hoarding, all manner of malpractices. And with the rush of, circulars from the CBN trying to plug so many loose ends, we are beginning to see some very good results. So for me, I think it's something that is extremely very good. The only concern I have is the liquidity management component of it.
Okay.
Because we also need to be careful not to ascribe this entire outcome to the liquidity management.
Right.
Because of course the CBN governor also acknowledged it. The trade-offs we are beginning to see, especially with regard to interest rates. Because interest rates has gotten to a level now that it's almost impossible for any real sector operator to utilize bank facility. And those that are already logged in those facilities, they are groaning as we speak.
Yeah.
Because we are talking about interest rates of between 35, 40%, depending on what level you are. So that is extremely, very, very challenging. And I'm also happy that the CBN governor has acknowledged that, and he said it's going to be temporary. I'm hoping that it is going to be temporary. Yeah,
no, I'm glad you talked about the other key indicators, interest rates. But before we come to that, Steve, I wanted to ask you, looking at the raft of policies by the CBN, as Dr. Muda has mentioned, liquidity still remains a challenge. But was there a specific policy that you think was the final trigger to start turning the tide? Because like you said, we saw a raft of circulars come out, circulars directed at banks, at BDC operators, at international money transfer operators, and so on and so forth. Which one of those do you think probably had the biggest effect in really turning the tide?
I think it's tough to actually pin down a particular policy.
Right.
Because there was a barrage of policies that actually came out from CBN. And we understood why, because of the peculiarity of the situation we had at that time. But in the middle of the entire policy arrangement, I think a few of those actually stood out, especially for the pricing, the NIFEX pricing. I think it created a bit of opportunity for people to see some level of transparency in the markets.
Okay.
And that helps a lot because once you start seeing the price discovery in terms of where the markets close on a daily basis, it gives direction to whoever that is coming to that window to come and purchase FX to know this is where it closed today. And tomorrow, whether liquidity is thin or is fluid, we'll find out what the market will determine tomorrow. I think another thing that happened was the fact that another one that actually, very, very key was the fact that they removed the caps in terms of the IMTO funds that come to the market. And that's, free
that's
up
the
the market.
international money transfer operators.
Yes, exactly. Yes. And that freed the market to some extent for them to be able to participate in the interbank market. And coupled with the fact that we saw some supply coming through the FPI, that's for foreign portfolio investors, who are coming to the stage because of the increase in yield on government bonds and T-bills. So I think that helped out a lot.
Yeah.
And again, when you look at the policies or the circulars on the net open position limit for the banks, where they cannot go long, zero long position, and negative 20% of the shareholders' fund, I think it helped a lot.
Okay, and of course, let's not forget the settlement of forwards.
Yes.
Because
I think that actually played a very key role again, because the fact that CBN came out and said we're going to do this, and they saw those particular policies through, it gave a bit of confidence and believe in all the policy trust that was coming from them.
Yeah, good point. And of course, the CBN was communicating at regular intervals, which I think was interesting. But Dr. Muda, Goldman Sachs, which had earlier predicted that the Naira would average out this year at 1,200 Naira, in its latest analysis is now suggesting a 1,000 Naira, that the Naira could breach, and there's still room for appreciation. Do you see that happening on the horizon?
Well, I see it happening for a number of reasons. Just as Steve said, the level of confidence is increasing.
Right. It
has become highly elevated by virtue of what the CBN has been doing. And confidence has a big role to play, in stabilizing the currency and in removing the speculative component of the pressure on the foreign exchange market. I think that is good. The second major point is the fact that we are likely to see a reduction in the pressure for the importation of petroleum products, with what is happening with Dangote and possibly the Port Harcourt refinery.
Yes.
Because if you look at the basket of imports, importation of petroleum products accounts for about 30%, of our import. And you can imagine that kind of pressure. In fact, there are some estimates that put the annual bill at about between $10 to $15 billion in terms of imports of petroleum products. So if we're able to take that out, that will ease the pressure and also help to strengthen the currency. But having said that, we also need to make haste slowly, because we need to come to a level that we can be sure is sustainable.
Right. Because
this injection that we are seeing, just as Steve said, there's a portfolio component there. And portfolio funds are not that dependable. They can fly out at any time. So we should not be raising too fast to the bottom, because we need to ensure, stability. So the CBN should begin to figure out at what level we can actually stabilize and sustain, these rates. Because we also there's a need to also gradually to now even begin to build our reserves. Our reserves is not as if it's in such a fantastic position. Even though when you look at the moving average, which is also always being reported, but in terms of what is unencumbered, it is not as if it's so fantastic. So where we are beginning to see this kind of forex liquidity, I think also an opportunity to begin to see how we can gradually begin to build reserves so that we can use the reserves to be able to stabilize the currency at a particular rate. So we should not be too much in a hurry, to raise to the bottom. I think that is what I think. But I think if you look at all the things that are happening, it is
okay.
The outlook is quite positive. And what Goldman Sachs is saying, I think, is something that is achievable.
Yeah, Steve, you had a response to that.
I just wanted to quickly add to what you said, because that's very key. I think it's high time we started seeing the harmonization of those policies, trust coming from both the fiscal authority and the monetary policy authority. We've seen the hands of CBN, how they are tackling these issues. But he said something about the cost to manufacturing companies.
Of course.
Who are approaching the market to raise money or whatever it is. And there's a level at which we can keep this high interest rate. You know, we're buying government paper at 27% yield for 1 year. We're doing 10-year, 20-year paper at around 21%. So there's a level at which you actually can keep some of these things. So for me, the FPIs have come in at the highs of maybe 1,600, 1,700. And now we're trading at 1,001. And they bought securities around those elevated levels. There will be a point where they will look at that opportunity and say, you know what, I've made enough money.
Let me get out now.
Let me get out now, because they're not FDI, they're FPI. So portfolio investors are hot money that can go at any time. So if you are building reserve using those particular funds, then there's a challenge or a threat along the line. But if you're able to build your reserve through direct investment that is coming to the country and some other measures from maybe mining, you know, exports that we talk about from the oil now, which has dropped, you know, if you can increase that, then it means we have more accretion to reserve, not just dependent on FPI coming to the system.
Yeah, and I think you make a good point there. You know, you said we've seen the hand of CBN. I thought you were going to say we haven't seen the hand of the coordinating minister. No, but I think it just highlights the need to have a more long-term structural approach to these issues. And Dr. Muda, before we move on to Zimbabwe, I wanted to quickly ask you around the impact on the real sector, the business, and whilst this tightening of monetary policy has helped us achieve some macro outcomes, from a business and real sector perspective, the sustainability of it, what more can we do to support manufacturing, to support SMEs in terms of these current conditions?
Well, the way things are now, the banks are not actually playing the kind of developmental role that we expect them to play in terms of support for businesses. Don't forget, the primary role of a bank is financial intermediation. What other roles they play are just complementary. If you look at the banking landscape today, we have the whole idea of financial intermediation has been almost completely eroded. Because, I mean, look at all the sectors of the economy. Look at manufacturing, agriculture, real estate, aviation, mining, name it, even broadcasting. How many of those sectors can survive with a credit interest rate of 30%, 35%? It's completely impossible. The same thing with consumer credit. In many of the advanced economies, it's consumer credit that actually drives the economy. Can you buy a car now as an individual with a bank facility? Can you build a house with a bank facility? So we are moving to a point where the banking system is increasingly becoming disconnected from the real economy. And that's a major concern. Of course, we have seen what the monetary policy, of course, we have seen some positive outcomes in terms of Forex and all of that. But I think we need to revisit it. Because you have a situation now, you have CRR at 45%. You have liquidity ratio at 30%. If you take those two together, you are talking about 75%. So what is left for purpose of financial intermediation? And look at the interest rates. So it is very important. And let me also make this point. I know that under the previous administration, this whole idea of intervention funds was abused. There's a lot of abuse. But I need to stress it that we also need concessionary financing.
So this will come from the development banks, or who will this come from?
No, from development banks. Right now, I think
so. The likes of DBN, BOI,
DBN, and Bank of Industry has become moribund for close to 5 years or more. Bank of Agriculture. They are not functioning at all. So we cannot drive this economy with this level of interest rate.
Yeah.
So it is important that we also double down on efforts to strengthen this other financing window, and also for SMEs.
Yes, of course.
The financing gap in the SME space today is not less than 40 trillion naira in terms of the gap in financing, because they are almost completely cut off. They account for probably less than 1% of the total credit in the banking system. So we need to bring the banking sector and the real economy into alignment.
Yeah, I mean, you make some very good points. We could talk a whole lot about it. We always talk about financing of SMEs and small business on the show, but because I want us to touch on some of the other dynamics happening elsewhere in Africa. Zimbabwe recently introduced this new currency, the ZiG. We saw what happened to the Zimbabwe dollar. But what is really interesting about this, and I have the statistics here, is that they're saying without adequate import cover and fiscal discipline and an independent central bank, this new ZiG currency will end up with the same fate as the Zimbabwe dollar, which we saw fall by over 70%. In fact, at one point, they didn't have a local currency and we're using the dollar. What is your assessment of Zimbabwe's ability to sustain this new currency? Steve, I'll ask you first. So pegged to gold reserves.
Exactly. So from my point of view, I'll be very optimistic because I always like people to try new things.
Sure.
So I would commend them for trying another new thing. But, those points you made are the issues with Zimbabwean government. The loss of confidence in the currency and the people that are managing the currency is gone.
Okay.
You understand? So there's no confidence in that, and that's what happened. We were almost getting to that point before we actually got our policies right, And once that happened, what you see is chaos. But what they're trying to do now is to say, you know what? We have too much money in circulation that is causing this hyperinflation. And you know the history of Zimbabwe from hyperinflation regime, even before the former president died, So it's been there. But what they are trying to do now is to say, let's rein on this liquidity of cash in the system and checkmate that by actually issuing a digital currency, ZiG, that is pegged to a gold, not like a fiat currency that is not pegged to anything, and trying to see how much of that would help in terms of save the currency. I think the first week of announcement, we saw a bit of positive feedback or reaction against Rand, which is major, whatever. But again, there have been challenges around some payments that actually cannot be done with that digital currency, right? They've talked about people buying for, you have to use, Zimbabwe dollar and all of that. We talk about applying for visa and all of those. So
the actual penetration of that currency within the wider economy, there's still a long way to go.
Yes, a long way to go. And I don't think Zimbabwe as a country has perfected a lot in financial inclusion. And that is going to be very key to the success of what they're trying to do.
Yeah. Dr. Muda, I'd love to hear your thoughts on this.
The thing is that it's as if the Zimbabwean government has been busy fighting the symptoms.
And not the underlying causes.
And not the fundamentals.
Yeah.
They have changed currency. This is the 6th time in the last 16 years. The issue is not with the currency. The issue is with the fundamentals.
The fundamentals are, as he mentioned, monetary growth.
A lot of money printing. You have weak exports. You have a lot of imports, dependence and all of that.
And
those
there's a governance side of it.
Governance side, issues of corruption. They have not addressed that. And you keep changing currency. Now, in your intro, you said that this gold-backed currency is just $285 million.
That's just 3 months of import
2
cover.
weeks.
2 weeks, sorry. 2 weeks.
2 weeks of import cover. How far can that go?
So what is the solution? These underlining
is actually very small.
Yeah, the assets, the gold reserves are very small, held by the Reserve Bank. So what is the long-term solution to Zimbabwe's underlying economic issues and structural problems?
No, it's simple macroeconomic management. They manage their he talked about issues of,
Maybe it's not that simple.
Yes, no. If you have the political support to make it happen. He talked about the independence of the central bank, for instance. He talked about issues of money printing. He talked about issues of curtailing imports, exports, and issue of corruption. So there's a lot that needs to happen from the political side. I know all this land reform that they did, that has also disrupted a lot of things around the agricultural sector. So there's a whole lot that needs to happen from the political side to support the necessary reforms that needs to take place. If those reforms don't happen, to rein in on all these issues of money supply growth, import dependence, and I mean, they'll be back to square one.
And interestingly, you know, the funny thing is, well, Nigeria obviously didn't change its currency, but Nigeria moved at one time to redenominate the Naira. The Naira redesigned the Naira. And I think what this really highlights is that in the absence of some fundamental basics, that actually some of these policies around currency reform will have consequences and won't have the desired impact except some of the fundamentals are fully addressed. And we saw that here in Nigeria, even though we're dealing with a slightly different issue around redesign as opposed to a replacement of currency. Well, you know, we wish Zimbabwe the best. Obviously, there's a lot of economic hardship there, and this is the government's attempt to put out a fire. But obviously, the underlying cause of what is fanning that fire still needs to be addressed. I wanted us to spend some time on the third country, Ethiopia, which is now in a situation where it's had some debt default. It's now facing the prospect of an IMF bailout. But as we know with IMF policies and Bretton Woods institutions, exchange rate liberalization is part of the package of any type of debt negotiation or transaction. What do you make of Ethiopia's choices between a rock and a hard place now?
Is that for me or for
Dr. Steve or Dr. Muda?
Okay, let me give the first shot. I think Ethiopian problem or issues in terms of these defaults is not peculiar to them alone.
Sure.
We've seen, you know, a lot of other countries who have defaulted. We've seen Ghana defaulted in Ghana 2023, which they're still talking now, you know, and that is part of what the problem is. And, you know, everything boils down to the management of both fiscal and monetary policy authorities, which is not being done properly. And that, you know, has consequences. The consequence is that once you default from that international capital market, there is a tag on you, which means that you cannot approach that market again, except you actually clean up your book. And in cleaning up your book, there's going to be a lot of demand coming from IMF or whoever they're actually approaching to do that. And that's what is going to happen to Ethiopia. So there's going to be a lot of, you know, restructuring of their entire balance sheet and the book, and there's going to be a lot of policy change when it comes to their currencies. And I don't think they're going to get that as soon as possible. Ghana has been on this discussion since last year. We're thinking by first quarter of this year, we'll have had something communicated to the market. We don't have anything yet. So Ethiopia is just about to start that
Ghana restructured their US dollar bonds, but the Euro bonds are still outstanding.
Exactly. So that journey is going to take a bit of time, but I think is the best way to go because there's nowhere to go to capital markets.
So you're essentially saying they have no options but to strike a deal with the IMF, and so currency devaluation is likely. Dr. Muda, what do you think?
You know, the IMF is like the last resort. When you have a major balance of payment crisis, which they have. Now you talk about a default. When you begin to default, if you don't quickly address it, it could lead to much bigger problems for the economy. So I don't think they have much choice in this matter. IMF typically, once you end up with them, of course they will give you these conditions. You know, float currency, remove subsidy, and you know, some of those things could work well. Some of those things are not actually, you know, good for some of the developing economies. But they don't have much choice, you know, because they have a major crisis. They, I think, recently even rescheduled their debts with the Chinese government.
And the Paris Club. The Paris Club.
They had a rescheduling. So if in spite of that, they are still not out of the wood yet, then they have to, they have to adopt the IMF principles and see how quickly they can get out of the crisis. Again, it comes to the quality of macroeconomic management. If you don't manage the macroeconomic environment well, then you run into this kind of problems. And when you run into these problems and you end up with the IMF, you don't have a choice than to abide by their conditions or conditionalities.
The lender of last resort has waived the stake. But let's hope that it's not a painful currency reform, that it's at least phased. And one must have to say that Ethiopia is still an attractive market. After all, we just talked about the Nigerian boss going to invest 5% in the Ethiopian exchange. So still a lot of upside there in the Ethiopian economy. And we wish Ethiopian, Zimbabwean and Ethiopian family all the best with this managing these economic challenges. Obviously, Nigeria is not alone insofar as macroeconomic reforms are concerned. But thank you for your insights, Dr. Muda, Yusuf, and Steve Osho. Great to have you both on the show together again, talking about pertinent economic issues.